You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen. It's the 12th of July, 2023, and this week we'll be discussing Sainsburys, Redde Northgate, Currys, Supreme, Bellway, and our US company of the week is Meta. John, shall we start with Sainsburys?
Yes, so it's the UK's third largest supermarket, and they had a trading statement out last week with first quarter retail sales up 9.8%, excluding fuel, with an 11% increase in grocery as the group's efforts to keep prices low and improve its product offering saw volumes increase. The group highlighted the popularity of its value brands, with entry price points as the fastest growing product tier. However, the high-end Taste the Difference products also performed strongly. Events including Easter and the coronation helped boost the performance. General merchandise also rose, but at a slower rate than grocery, with Argos driving this. Clothing sales, however, fell 3.7%, partly reflecting the cooler weather. And the financial services business is performing in line with group expectations. The group highlighted that food inflation is starting to fall and full-year expectations are unchanged, including underlying pre-tax profits of between £640 and £700 million. In terms of valuation, Sainsbury's has a market cap of just under £6.4 billion and trades at 13 times earnings, with a prospective dividend of 4.7%. I thought this statement was pretty decent, particularly with the volumes increasing, although still in for a tough time in the near term, with their margins being squeezed as they competed with Aldi and Lidl on price, but also the bigger players who are price matching too, like Tesco's. And on that point, I would add that in terms of valuation, it's almost identical to Tesco's, which is arguably the better business. So as a Tesco shareholder, I would just be sticking with Tesco's. And if I didn't have shares, I'd probably be, I would with my bias, but be moving towards looking further at the Tesco's, because there isn't that sort of differentiation. If Sainsbury's was a much more significant value play, then perhaps Sainsbury's could edge it on a value basis. But everything else being equal, I would be choosing Tesco's over Sainsbury's. Sam, what are your thoughts?
I thought it was a very good quarter. We've discussed, when we've covered previous Sainsbury's results, that we felt like the strategy has been the right one. I don't recall previous results giving the kind of results that this quarter has. I think this is the first quarter where the strategy seems to have actually benefited them rather than just allowed them to tread water. However, although I think it is a very good quarter and the strategy is working and it is the right one, I would agree with your comments that Tesco is the better business. So I think if they're a similar valuation, although they're probably doing as well, management are probably doing as well as they could be in the circumstances, I would rather buy the better business. So although I think it's a very good quarter, I would also go with Tesco.
And it's not like, PZ Cussons, as we covered, and then comparing it with, say, Reckitt or Unilever, there is more differentiation in terms of the market, or what the market thinks the valuation multiple, which, like I say, with Tesco's and Sainsbury's, doesn't seem to be there as significantly.
Yeah, so if you can have the better business at the same price, it's just a bit of a no-brainer.
Okay, next company.
Yes, so it's a debut on the show, and it's Redde Northgate. I think that's how you pronounce it, but I'm not 100% sure. If I'm wrong, I'm sure someone will tell me. So Redde Northgate is, firstly, it's listed on the FTSE 250, and it's the leading integrated mobility solutions platform, providing services across the vehicle lifecycle. The group provides integrated mobility solutions to businesses and personal customers. These solutions comprise vehicle rental services, accident and incident management services, repair and maintenance services, vehicle disposal and other ancillary services. to keep customers mobile. And they've said, we support our customers through a network and diversified fleet of over 130,000 owned and leased vehicles, together with over 700,000 managed vehicles from around 175 branches across the UK, Ireland and Spain, with a specialist team of over 7,400 colleagues. So the main line of the business is vehicle rental, but then other stuff to do with, and it's primarily commercial vehicles, so vans and stuff, and then other stuff to do with that, like the repairs, and actually do like EV charging as well now, but that kind of stuff. They have come out with their full year results for the 12 months ended 30 April, and revenue was up 19.8% to 1.489 billion. Earnings before interest and tax was up 34% to 202 million, but only up 12.7% on an underlying basis to 189 million. And the underlying basis excludes vehicle sales revenue, exceptional items, amortization of acquired intangible assets, and adjustments to underlying depreciation. Profit before tax was up 34.7% to 178 million, and earnings per share was up 46.2% to 60.3p a share. Revenues excluding vehicle sales were up 22%. I think they're excluding vehicle sales because if they're commercial vehicles, they'll probably be making unexpected profits when they're selling some of the older vehicles because of the way the second-hand market is for vehicles. So I think that's why they exclude it. Underlying profit before tax was up over 9% to 165.9 million due to strong operational performance and volume growth, partially offset by higher interest costs. Net debt was up 111.9 million to 694.4 million. Free cash flow was down 15.3 million to 4.5 million, and return on capital employed was up from 13.9 to 14.1%. So he said the free cash flow decrease reflects investments in fleet and working capital to support new multi-year contracts and investments in Blakedale, which we'll discuss a bit later. They've got a healthy balance sheet with over 290 million of facility headroom. Bank facility extended out to 2026, 1.5x leverage at the midpoint of the stated target of 1 to 2x, and 62% of this is fixed for 2023 financial year, including private placement at 1.3%. They've said the return on capital increase reflects the focus on maintaining strong cost control, disposal profits, and disciplined capital allocation. And then they've said there was a 10% increase in the final dividend, reflecting the board's confidence in outlook. A £60 million share buyback completed in December, acquiring 7% of the share capital, which is a decent amount. The group fleet's up 3% to over 130,000 vehicles, driven by growth in Spain and replacement vehicles for insurance contracts. They've said LCV scarcity is continuing. What would LCV be? I think CV is commercial vehicles.
LTV, did you say?
LCV.
Oh, sorry.
I think maybe let commercial vehicles. Continued progress in value-added services, now over 10,000 in telematics units. And then cross-platform Northgate, UK and Ireland accident management services customer revenues are up 150%. The acquisition of Blakedale was in July 2022 completed, and Fridge Express May 23. We said Blakedale customers are up 28% and fleet customers up 30% since acquisition. They've said for Northgate Accident Management, that was up 50% for additional services, with over 6,700 EV charging points installed. Blakedale, one of the businesses they purchased in the period, that's a traffic management vehicle hire company. And if we split the results a bit more, this is essentially two businesses. So it's Northgate, which does commercial van hire, and Redde, which does motor claims accident management services. Northgate, UK and Ireland, that had revenue of 367 million, and that was up 6.1%. Northgate Spain had revenue of 252 million, that was up 14.6%. And Redde revenue from claims and services was up 35.9% to 738 million. In terms of the valuation, the business trades at a P ratio of 6, and dividend yield 6.8%. I'm not a big fan of that. So I'm not a fan of that at all. So dividend yield 6.8%. So it's paying a pretty decent dividend, but the debt increased by about 15-20% in the period. And I know we cover this Probably at least one company a week, but why are they borrowing £100 million to pay a dividend? It's just stupid. But anyway, P/E ratio of 6. I think these results were fine. It's not the most glamorous business in the world. I don't think it's a business for me. It's kind of a bit similar to Ashted, which do like the digger hire and stuff like that, where it might be a very good business, might be a very well run business, but this is going to be a low margin business, I think. And it's going to be a business that is very capital intensive. And you see that in the free cash flow. Free cash flow, much worse than the earnings. And that's probably because they've got to go out and buy new equipment pretty regularly. And they've got to keep their fleet at a certain age. So yeah, it's probably very cyclical as well. I imagine the success of the company will rise and fall with the business environment.
Yeah. I was about to say, I think that may well account for the current valuation too.
Yeah, it looks like a cyclical valuation. So yeah, the results were fine, but in terms of the business, it's just not for me. John, what are your thoughts on the results and the business?
I would pretty much echo that. The only thing I was going to add, other than the valuation being pretty low and it likely being white vans being linked to, I suppose, the true British economy or true state of the British economy, is it's based very near you, Sam. Headquarters is in Darlington, yeah.
Oh, I didn't realise.
So yeah, and interestingly, in 2005 they acquired Arriva, of the sort of Arriva buses that you will see around, which is based in Sunderland. But yeah, there's no local bias anyway on this show.
No, we leave our biases at the door.
Yeah, and probably away from Northgate. Okay, on to the next company then, Currys. It's the electronics retailer. It's, I think, FTSE 350 now. It used to be quite big, but has had difficult times, which are continuing. They had their full year results out last week, with full year revenue falling by 7% to £9.5 billion on a like-for-like basis, with declines in all markets except Greece. This was down to the fall in consumer spending as persistent inflation and rising interest rates hit demand. Group underlying operating profit fell 24% to £214 million. However, the UK and Ireland division saw a 45% uplift to £170 million, driven by a focus on more profitable sales and a successful cost-cutting programme. The international division was more stark, as underlying operating profit fell 73% to £44 million as the market became overstocked, leading to heavily discounted products, which prevented the pass-through of inflated costs. Free cash flow fell from an inflow of £72 million to an outflow of £74 million, driven by the lower profitability. The £44 million net cash position turned into a net debt position of £97 million. And Currys said that the economic outlook remains uncertain in its main markets. No current year guidance was given, but longer-term guidance for operating margins to reach 3% was reiterated. And the group didn't, unsurprisingly, decide to declare a final dividend. In terms of valuation, Currys has a market cap of £595 million and trades at 7 times forward earnings, and it doesn't currently pay a dividend. Shares were down 12% on the news. I mean, it's a company that we've covered a few times now. I like it less and less. I think it's, well, I don't see an electronics retailer in the 21st century, the traditional bricks and mortar, really surviving when you have big players like Amazon. So I would be very bearish on this stock, and even like on a sort of a value play, I wouldn't be looking at it. Sam, do you have anything more positive to say about Currys?
I don't. I always find it interesting whenever we cover it that it's got the Greek business. I don't know why. I always seem to forget, and then I'm like, oh yeah, that's in there. And it was the only business that performed okay, actually.
Yeah, I was about to say.
I don't think the results have ever been particularly inspiring. However, these are obviously the worst results we've seen since we started covering them on the show. The net cash to the net debt doesn't look good, and it is in such a difficult business anyway that, yeah, it's the smallest drop can just have a huge impact. I mean, that's off a 7% drop in revenue, and I don't know if that carries on for too long, it could be in a bit of trouble.
Yeah, like a Comet type situation.
Yeah, let's see I'll just have a look at the market cap.
595.
Yeah, so already it's already a decent chunk of the market cap. So hopefully, obviously it's not nice to see, but hopefully they'll turn it around. Because if they don't need too many more years like that before they're in serious trouble. So yeah, not good. I wouldn't touch it with a barge pole. I wouldn't have anyway.
Yeah. Okay. Fine. Moving on to a company that you own, Sam.
Yes. I don't know if maybe it's fair to describe it as a favourite of the show, but I've always spoken very positively about it, trying to exclude my own biases, which, as mentioned before, we do leave at the door. Supreme, they do a number of things, covered them multiple times, but they are a leading manufacturer, supplier, and brand owner of fast-moving consumer products, which mainly include vaping, which we will discuss in quite a bit of detail. So they have released their full-year results for the year ended 31 March 2023, and revenue was up 19% to 155.6 million. Gross profit was up 6% to 40.9 million, and the gross profit percentage decreased 11% from 29 to 26%. Profit before tax was down 11% to 14.4 million, and earnings per share was down 13% to 10.3p a share. Operating cash flow was up 64% to 19.3 million, and net debt increased from 4 million, 195% to 11.8 million. But based on the profits, it's not a level where I'd be concerned about it at all. They've said the revenue growth of 19%, half of it was driven by earnings-enhancing acquisitions, and the remainder from strong organic growth. And that's quite interesting because I was watching the November presentation from the interim results, and they've made quite a few acquisitions where it's like, for example, like smaller vaping brands and stuff, and they'll just shut everything down, get rid of all but like 2 of the staff, bring all the production in-house to where they are in like Manchester, and they just turn it into like a profit machine. So I think they had one where I'm making up a number, but they'd spent like 3 million on it, and within the first year it'd pay back 2 million or something ridiculous. So these acquisitions really don't take long to pay back. They are being very, very smart about it. They said the vaping division delivered a record performance, nearly doubling revenues to 76.1 million. And that's up from 43.6 million, an increase in gross profit from 19.5 to 28.1 million. So probably about 70% of the firm's total gross profits are now coming from vaping. So it's becoming more and more a vaping story, as if it wasn't already enough of one. They said they were highly cash generative in this period, delivering 19.3 million of cash from operations in the period, up from 11.8 last year, resulting in an adjusted net cash position of 3.2 million by the year end, and that compares to adjusted net debt of 1.9 million last year. They've had record levels of investment in mergers and acquisitions and capital expenditure of 11.3 million, and that's up from 3.8 million last year to support future growth. They disposed of the T-Juice brand, which generated 4 million of cash in the 2023 financial year. And the ongoing strategic partnership with the buyer means Supreme retains exclusive manufacturing rights. They completed 3 acquisitions in the period, and they said 2 were successfully and immediately integrated into the company. They secured a 15-year lease on the new facility in Manchester, which will significantly expand the group's in-house distribution capabilities, with activities from the site expected in Q2 of 2024. In terms of the outlook, they've said the group has made a very solid start to the 2024 financial year. The core business and the 2023 acquisitions are all performing strongly, and as a result, the board expects adjusted EBITDA to be ahead of latest expectations by at least 1 million. In addition, the group now expects to generate a further 25 to 30 million of revenue and around 2 million of incremental adjusted EBITDA in 2024 year, in respect of a master distributor appointment with the UK's leading vaping brands, Elf Bar and Lost Mary. As a result, the board now anticipates that trading in the 2024 financial year will be significantly ahead of the current consensus. So, moving on to that, on the same day they released the results, they released an announcement of a significant vaping distribution appointment. They said Supreme, a leading manufacturer, supplier and brand owner of fast-moving consumer products, announces that in June 2023 it was selected as master distributor for the UK's leading vaping brands, Elf Bar and Lost Mary. Management, following initial volume orders, currently expects to generate 25 to 30 million in revenue and around 2 million of incremental adjusted EBITDA for the year ended 31 March 24, alongside an investment into working capital to support growth. The company will supply Elf Bar and Lost Mary products to some of the UK's biggest retailers, including Tesco, Morrisons, One Stop, and WH Smith Travel, enabling the group to develop cross-sell opportunities encompassing the entire Supreme product range. So I think this is quite a key point, because one thing they have been very, very successful at is once they get into a retailer, for example, B&M, with B&M, they will supply the batteries, they will supply like the vitamins, they will supply the lighting. There will be stuff where it's cheaper for B&M to get Supreme to do it because they're so efficient than to actually create their own brand in-house.
Yeah, it's interesting on that point. Paul McDonald, who's the chairman, he was the finance director of B&M from 2011 until they floated. That was just chipping in on that.
Oh, it's very interesting. Thank you. So, so with B&M, for example, once they started going for the vaping, obviously all the vaping stuff sold in B&M is 88 Vape, which is Supreme's own brand. When they launched the disposable vapes last year, straight into B&M, one thing they're very, very good at is once they've got a foothold in the door with a retailer selling all these other products. So like, I don't think you would typically, apart from the Duracell batteries and stuff, I don't think you would typically see Supreme products in Tesco. Like when you go and look at the vaping section in Tesco compared to like a B&M, it's not Supreme products. So it would be very interesting if now they've got the foot in the door, can they get, say, the 88 Vape and stuff like that in there as well, and some of the other products? So this could be a massive deal. And then they've said Supreme's market-leading presence within the UK vaping market and its extensive distribution network, alongside its established compliance, governance and quality control capabilities, provide these brands with a ready-made blueprint for their UK distribution strategy going forward. Sandy Chadha, CEO, commented, "We are delighted to have secured such a sizable distribution appointment, which will allow our business to fully leverage its unique technical, regulatory and compliance and quality assurance capabilities within the vaping sector. We've seen a hugely positive response from both established and new retailers who view Supreme as an ideal partner to supply these products across the UK. Now I look forward to updating our key stakeholders on our ongoing process for the remainder of the year." I think this is fantastic. They already had, by volume, a 30% share of the UK vaping market. And this is a market in which Elf is absolutely dominant. So if they've gone and picked up Elf and Lost Mary, it's getting to the point where it's going to be hard to actually buy a vape in the UK without Supreme profiting on it in some way. And I'm not joking. I think it's genuinely at that stage. There's not, you've got a couple of other brands, like I know Philip Morris have their own one. You've got like the Views one and stuff, but the majority of the big brands now, it's all going to be in some way linked to Supreme. In terms of valuation, business has a dividend yield of 2.65%. As a shareholder, it's a nice little dividend. The debt's not at a concerning level, but I like the acquisition strategy. I trust the management. I think they're doing a good job. I'd rather see the dividend slashed to zero. I think they can do a better job with that 2.65% than I can. So I'd rather they didn't pay a dividend. So there's some unbiased coverage for you. And in terms of the valuation, P ratio is at 9.58. I suspect it's very small, so I think that's partly why. It's only 132 million market cap. I also suspect it's a bit of a tobacco industry. What's the word I'm looking for?
Sort of a sort of stock.
Yeah,
ESG
stock
issues,
valuation. Yeah. But I mean, for the numbers this is putting up, for the potential future it has ahead of it, for the new distribution, I just think 9.58 is incredibly cheap. I hold it. I'm very happy with these results. I haven't watched the shareholder presentation yet, but I do intend to do so. John, what are your thoughts on these results and the valuation?
Again, I'd echo what you said. I think very positive. I'd pick up on a couple of things that they mentioned, and this is maybe, if you were to make the bear case on it, where it would hinge really. So they do comments about Supreme's ethos to support a tobacco-free UK by offering all adults credible, affordable and safer alternatives to nicotine consumption. And Supreme has consolidated its position as a market-leading manufacturer, distributor and brand owner in the vaping sector, and continues to explore additional opportunities to grow both its market share and its ever-expanding industry, boosted by increasing government support. And I think it is very important, because if there were to be more regulation, this is the sort of stock, whilst it's not highly valued, to be sort of hit harder, as we saw with the traditional tobacco companies. And perhaps that is the worry with it. if, whilst and I know we've sort of mentioned it on the show before, is it sort of harm reduction? How do you look at it from a sort of public health perspective? But if there were to be regulation one way or the other, that is going to hit Supreme, and probably quite hard. I know it's diversified in the sense that it's got lighting, it's got its sports, nutrition and wellness business, and the batteries too, but it's pinning its hopes on vaping. So if that were to change dramatically, it would be hit hard. And that, I think that's the only thing I'd add to what you said, Sam, because otherwise it looks like it's doing very, very well. And if the vaping market continues to grow and continues to receive government support as sort of a form of harm reduction, then Supreme has a long way to go.
Yeah, I would agree with what you said. I think, especially as, although like you say, it is quite diversified, 70% of the gross profit now comes from vaping. This is becoming more and more a vaping story. If something negative happens to the vaping, it would be a disaster. As much as I rate the other parts of the business, like, for example, I am in it for the vaping, really. But I think as well, I do think, and they are always very keen to get us across in their investor presentations, Department of Health, Cancer Research, all these bodies, the data does show that vaping is the most efficient way to quit smoking. I think over 95% better for you, the data suggests, than smoking. However, government policy is not always guided by the data. It is much more guided by the story the media creates. And if the story, for example, the media creates is that you've got younger kids and they've got these fruity flavors, you've got all these people who've never smoked that are just going straight into vaping, which currently the data does not show. However, you will have more and more people turning 18 every year who have never smoked that I think have the opportunities, because I think it will get, and you'll have a smaller pool of smokers moving across. So I do think that will change. But if the media story becomes people aren't smoking, but they're getting straight into vaping, and these are people that never would have smoked had it not tasted of strawberry, the position very quickly changes. Also, when you look at it, when you look at the amount of tax they're paying, I can't remember what it is and I've not written down the figure, but if you look at the amount of tax they pay on their products compared to what a tobacco company has to pay on its cigarettes, there is no comparison.
Yeah.
So that again,
that could be something difference. Exactly.
At the minute, you would hope the government strategy remains, we want more people vaping, because if they're vaping, they're probably not smoking. Eventually, it would get to a critical, assuming there's nothing along the way in terms of the media and what I would consider to be more illogical government policy. Eventually, you would expect it would get some kind of critical mass where they then start taxing the vapes as they did the cigarettes and just use it as a cash cow. If you could get to that position, it would be fantastic. It's a long way away from that. But yeah, I think your points are very, very valid, and that is probably the biggest risk facing the company.
And I don't know whether it would be one of those targets for acquisition, a bit like Juul with the e-cigarettes Philip Morris acquired a few years ago, or whether I suppose the market might then be a bit too concentrated, if it were, say, British American or Imperial Bright. Well, I don't think Imperial are going to buy it, but say British American Tobacco, for example.
I don't know why Imperial wouldn't be a disaster, because Imperial's mainly UK, isn't it?
It is, but it did pay a lot. I'm not sure whether it was 7 or 14 billion. No, it must have been $7 billion for Blue from Reynolds a few years back, and that's done terribly.
No, but when you look at, I just think with these, when you look at how big the tobacco companies are, and how, I mean, British American is like a £50 billion business.
Yeah.
Supreme's 130 million market cap. You could go in and offer 250 million.
Yeah.
And it's absolute peanuts. And you've basically got the UK vaping market locked down. And if it doesn't work, you've not lost a huge amount, especially the amount of cash these things are generating. If I was running a big tobacco company, it would be on my list, but I don't know. I'm sure they've considered it. Someone must have.
Yeah. Well, that's the other thing. So Sandy Chander, who is the chief executive, he owns 57% of the company. So
yeah,
it wouldn't be down to the rest of the shareholders to be, or even institutions to be making that call.
Which I think is probably a plus. Because
do you think they might take it before the growth
I think they
happens?
would. Like
yeah.
If I just think, because I do think you are getting a sin stock valuation at 9.5 times earnings with these kind of numbers, and the fact they've just come out and said we're going to smash earnings. We're now distributing for the biggest brand in the UK for vapes.
Yeah,
I think it is undervalued. I think the tobacco companies would recognise that. I just think even if they came in and offered double what it was trading for, it's like it would be nice, but it's like you'd hope over 5-10 years if you held on to it, you could do better than that. But yeah, it'd be interesting to know if he's ever had any offers or anyone approach him about it, because I don't think that would actually be revealed to the shareholders.
Yeah.
I don't know. I don't know what the rules are. Maybe he would have to. But if he doesn't want to and he's got 58%, I don't see why he'd have to announce it. But there might be some kind of company law where he does. But yeah. Should we move on to Bellway?
So yes, Bellway, the UK house builder, had a trading statement out last month from the period from the 1st of February to the 4th of June. They commented on a sustained improvement in sales demand through the spring selling season compared with a challenging trading environment in the fourth quarter of the calendar year 2022. And overall reservation rate averaged 190 per week, and the cancellation rate remained modest at 15%. That compares with an overall reservation rate of 253 in 2022 and a cancellation rate of 12%. The private reservation rate was 139, down from 198 in 2022. Overall, headline pricing has remained firm across the regions, although targeted incentives continue to be used in certain parts of the country to attract customers and secure reservations. And they comment on the strength of their land bank and an ongoing cautious approach towards land investment in the current uncertain market, with 4,342 plots have been contracted since August 2022, compared with 13,496 plots in full year 22. They have a strong balance sheet with net cash of £42 million, which is down from the 5th of June 2022 of £160 million. By the end of the financial year, net cash is expected to increase to around £200 million, compared with 245 on 31st July 2022, providing continued resilience and strategic flexibility. The £100 million share buyback launched on the 28th of March 2023 is progressing well, with 1.87 million shares purchased at a cost of around £44 million during the period. A lower yet still sizable forward order book has a value of £1.7 billion compared with £2.4 billion a year earlier, which comprises of 6,172 homes compared with 8,152 a year earlier. And in line with previous guidance, the group is on track to deliver full-year volume output of around 11,000 homes, down from 11,198 the previous year. And overall average selling price is expected to be around 300,000, down from 314,000. Jason Honeyman, the chief executive, commented that Bellway has delivered an encouraging trading performance, buoyed by a seasonal uplift through the spring, and the group is on track to deliver full-year volume output of around 11,000 homes. Whilst customer interest is currently healthy, the board remains mindful that the cost of living pressures and the uncertain path of future interest rates could impact on housing demand. They go on to comment about the market in current trading environment, with customer demand for our energy-efficient homes has shown sustained improvement compared to the very challenging trading environment in the fourth quarter of the calendar year 2022. While overall headline pricing has remained robust across our regions, we continue to use targeted incentives in some instances to secure reservations. Mortgage rates are currently higher than the equivalent period last year, although customers are adapting to the new higher borrowing costs, and affordability has been helped in part by ongoing wage rises. While overall mortgage availability has improved in recent months, the repricing of mortgage products as lenders respond to the changes in interest rates continues to affect shorter-term availability. The recent expiry of Help to Buy in England has led to lower year-on-year demand for the first-time buyers, and there remains a relative lack of affordably priced higher loan-to-value mortgage products. The average private weekly reservation rate was down by 29.8%, 139 compared with 198, and was achieved from an average of 239 outlets, down from 240. Help to Buy, which is still available to customers in Wales, was used for only 1% of reservations in the period, down from 16%, and overall sales rates are lower than the comparative period. The cancellation rate remained modest at 15% compared with 12%, reflecting good underlying customer confidence. The lower reservation rate in the period has driven a reduction in the value of the forward book order, however, it does remain sizable with a value of 1.7 billion compared to 2.4 and comprises of 6,172 homes, down from 8,152. And given the profile of completions in the coming months and prevailing reservation rates, a further decrease in the order book is likely by the 31st of July this year. During the period, build cost inflation has persisted across the industry, both from labour and materials. And since January 2023, low demand for construction materials has supported an improvement in product availability across the group, and we continue to expect overall cost inflation to ease through the remainder of the calendar year. The group is on track to deliver full-year volume output of around 11,000 homes, down from the 11,198 in full year 22, with overall average selling price of 300, down from 314,399. And in the financial year 24, given the reduced order book, lower prevailing reservation rates and uncertain interest rate environment, they continue to expect lower year-on-year volume output. We've covered the house builders a lot. We haven't covered them that recently. You are seeing the cycle turn very much now. And it's not surprising that the reservation rate has fallen by a quarter, the forward order book down 29%, and the average selling price falling to 300,000. What's interesting is the company is trading at a 26% discount to the tangible net asset value. And I think if you do take a longer term look, as I am as a shareholder of Redrow, I think there is potentially quite a lot of value available in these stocks. We don't know where the bottom is, but they're certainly in a position where they've got much, much stronger balance sheets than 2007, 2008. And it could be that as we're approaching the bottom, and who knows where that is, if you're willing to take that long-term view and look at the structural trend and shortage of homes in the UK, and both political parties, but potentially the opposition, who may well, if you believe recent polls, be in government in the general election, which is within the next 2 years, then Bellway and these big house builders are likely to form some part of the solution, which could be very lucrative. And as I mentioned, they're very cheap shares at the moment. So I think if you were prepared for that, and for it to be a very bumpy ride, as things do improve, Bellway and the house builders may well be those first companies to respond, as they have been when the market has taken a turn for the worse. They're the first company, they're almost the sort of canaries in the coal mine, really. So I would still remain bullish in the long term on the sector, but I appreciate that these are never likely to be the numbers that you'd be hoping for. Sam, what are your thoughts on Bellway and this trading update?
I didn't think the trading update was that bad. I think if you were to look at the interest rate at the minute and then predict the trading update, I think you'd maybe predicted a worse one. We were speaking off air about this and whether or not there is a lag effect. And I do think there has to be. As we were saying off air as well, what's really interesting is even if you could have known exactly what was going to happen with all the macro. And I think I'd have predicted the outcome completely wrong. So it is difficult. I think these results are all right, but I just think with interest rates where they are, I don't see how demand can do anything other than drop. Now, these results are not terrible. They still have a decent order book. It's not as good as it was, but it was fantastic, whereas it's still decent. I think something has to give. And I think it's got to be the prices, because with the interest rates getting higher and higher, it just gets to the point where people just can't afford to take the level of mortgage out that they were taking out 2-3 years ago. That being said, I've been very wrong so far, so I wouldn't give that much weight to what I'm saying now. But yeah, the results were fine. I agree it's cheap, but it's just such a hard industry to predict. I think if you're taking a long-term view, though, like you point out, and we point out every few weeks whenever we cover a house builder, there is an undersupply of housing in the UK. So as a long-term play, I do think it's good. I would take the discount to asset value at a pinch of salt, because that's a big assumption with the assets. especially in the short term. But it's difficult. It's really difficult with new builds because the main reason they sell so much is because it costs so much to build. So something has to give way on that side as well. Otherwise, it's just cheaper not to build them. So it's really, really tricky. It is difficult.
Yeah. No, I would agree with you on that. And the market is obviously taking a different view on the net asset value and probably the value of some of that land.
Yeah, I do like long term. I think there's a lot to like about the sector, but short term, God, I wouldn't want to predict it.
No.
If you're going to be in it for less than 3 years, I really wouldn't bother.
No, absolutely. I think it's a 5+, maybe a 10-year plus type stock. But certainly, I think they learned a lot from the last crash.
I think they're much better run businesses. I would agree with that.
Yeah. Okay, then. On to our final company of the week, Meta.
Yes. So I don't think Meta have actually come out with any results, but I wanted to discuss Meta just because, as everyone is, well, as a lot of people are probably aware, in the last week they launched Threads, which is basically a clone of Twitter. And I mean, anyone that uses Twitter, if you've not got Threads yet, check it out. It's exactly, I mean, they've not even been subtle about it. I appreciate there's only so many ways you can probably present a microblogging platform, but any differences are slight and probably just cosmetic. It is basically the same app. So I think it got to 50 million users in its first day. And for reference, I think Twitter has between 300 and 400 million active users. I can't remember if that's the daily or the monthly figure. I think it's the monthly figure. So within a day, it's at 50. It's been live for about a week now, and it's now at 100 million users. And I just think it's very, very interesting because we've seen it before with Facebook. They're not the most innovative, but because of their scale and their size, they don't really need to be. They've cloned stories from Snapchat. And although Snapchat's still around and still doing fine, I suspect what it's done is it's just killed Snapchat's growth. Because I remember when stories came out when I think we were at university when it came out. And at first, everyone was at Snapchat, and then they started using both. And then now, no one my age uses Snapchat. It's all on Instagram. And I know that like the Zoomers do still use Snapchat a lot. But I suspect what it did was it killed Snapchat's growth, or certainly massively impacted it. So I think this is very serious for Twitter, probably more serious than anything that's come out. And I certainly wouldn't have wanted to have just done a leveraged purchase of Twitter for $44 billion within the past 12 months using overvalued Tesla stock as my collateral. But yeah, Elon Musk hasn't taken it very well either. So I think there was already a prearranged charity boxing match or something arranged between Elon and Mark Zuckerberg, which is still going ahead to my knowledge. In the last year as well, Facebook have hired quite a lot of ex-Twitter employees that have been sacked by Elon Musk after he took it over. So that's probably why they've been able to get something that's so close so easily. And probably why it's like a year after Elon's gone, because they've probably taken all the staff and used that. But yeah, besides the charity boxing match, Elon has not taken it very well. So he called Zuckerberg Zuck the Cook, and then he also said that instead of a boxing match, or as well as a boxing match, I can't remember, but he suggested a dick measuring contest. So yeah, it's just very entertaining, but I just think it's very, very interesting in terms of a product launch from Meta. In terms of the Meta valuation, which is Facebook, it trades at 38 times earnings, which I thought had to be a mistake, and I checked a few sites, and it does look correct. It's currently trading at 44 times free cash flow as well, but it's currently $309 a share now, and within the past 12 months you could have bought it at $90 a share if you'd got it in October. So it's over triple bagged in a year, and it was very unloved, and I think it was too cheap then. I think it's probably a bit too expensive now, but it's a quality business. I do think Threads is here to stay. I actually quite like it. I don't notice a huge amount of difference between it and Twitter. So I probably will carry on using both for now, but it was very interesting because a lot of the accounts I follow have just already moved over. Not 100%, but a lot of the accounts that I like have just moved straight over to Threads. Very interesting as well, because I think when you first join it, it allows you to just import all your followers and following from Instagram if they've got a Threads account. So you automatically follow everyone you follow on Instagram already. So it takes away the biggest problem with Twitter, which is setting up, like figuring out who to follow. So it makes it a lot easier. But yeah, I just thought it was very interesting. So John, thoughts on Threads and the valuation of Meta?
I mean, I'm not a Twitter user. I do have an account and possibly has one tweet on it.
100 followers, though.
So It's a good
They're
ratio.
from the show. You've got about 100. I think you might. You're at 90. I'll check, but you were at 99 last time I checked. No, you're at 98. You've lost one. Sorry.
I'm not as interested in threads or the practical application of threads. If it's doing well for Meta, though, then that is, more interesting to me. I remember you saying how cheap you thought Meta was, and you've been talking about it. Was it 14 times earnings? I didn't buy shares then. I do think it's, as you say, it's a quality company. I can be a bit nervous with some of these tech stocks. I do have a decent amount in a passive form with an all worlds tracker, so it's in there. I do think it's a good company. I wouldn't be buying shares at this valuation, but I think sometimes that's, the difficulty with these really high quality American tech companies.
So I did buy it around then, but I think I sold it a few months later to buy Disney, which hasn't moved. So I think I might have made like 10%, but I wanted Disney and I had to sell something. So yeah, I don't really mind it though, because it was just, I held it for so little. If I'd held it for like 3 years and then sold it, I'd probably be a bit more upset. But I did make a profit on it as well. It wasn't my intention to get out so quickly, but I got to the point where I just really wanted Disney, because I'd previously sold out of Disney. Had I? I think I might have previously sold out of Disney as well. I think this is the second time I've owned it, but I got to a point where I really wanted Disney again, or I wanted more of it. I can't remember. So I actually sold it. So I haven't benefited from this massive run up that I'm talking about. That's anyway,
very sad.
So of the 6 businesses we've talked about this week, Sainsburys, Redde Northgate, Currys, Supreme, Bellway, Meta. Ethical reasons aside, if you had to buy one, which one would it be? And which one do you dislike the most?
Dislike the most is easy. I'd go for Currys and probably go for Bellway, but taking a very long-term view.
So I would also go for Currys for least favourite, and then for favourite it would be Supreme, and that'd be like quite some distance. If it wasn't for the valuation, Meta could be in with a shout. But I still don't really. One issue I have with Meta is I didn't like in the last year. I think it's only in the last year I became aware of like how much of a potential problem it is, the amount of controls Zuckerberg has. So he was just like, I'm trying to think of like a more appropriate phrase than pissing money away, but he was just wasting money on the metaverse, or not wasting money, but it's just so much money was getting pumped into it. And you looked at the graphics of the things it was coming out with, and it just looked rubbish. And there was nothing anyone could do to stop him. If he wanted to use the next 10 years of profits for the metaverse, there's nothing you can do. And yes, he seems to have pulled back on that now, but that was not a guaranteed thing. And yes, the value, I think you're paying quite a high price for something over which you've got no control over its future. If Zuckerberg wakes up tomorrow and he wants to go back into the metaverse, there's nothing you can do to stop him. So I do like the core business. I think it's quite pricey at the minute, but I would be very cautious of that, having experienced what he's done with the metaverse now.
Interesting. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.